Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let's get into today's episode. I came across a chart on Twitter or X, whatever you want to call it. I think we still all call it Twitter, but that illustrated property price growth with money supply. And like always, I've got the link to that chart on the blog on the website, and the link to the blog is obviously in the show notes. Anyway, it shows in the US over the last 10 years to 30 June this year, money supply has increased by 83% and home prices have increased by 90%. Now, money supply is essentially savings in bank accounts, really cash, if you like, in the economy. And I guess the more cash in the economy, it shows that the economy is doing well because people have, surplus cash and they're able to save and so forth. And so the idea, I guess the thesis behind the chart that invited us to, draw a correlation with is that the more money in bank accounts, the better property prices do. And that's a good way then of predicting what might happen with housing supply. Now, correlation isn't always causation. So just because these two things have moved in the same direction relatively similarly over the last 10 years doesn't necessarily mean that there's a relationship there, of course. But I looked at the chart and I thought, well, that's kind of interesting. Then I thought, well, wouldn't it be good to explore whether that relationship exists in the Australian market? And specifically because I listen to or read stuff every now and again, and economists and commentators and so forth talk about population growth. And the thesis is, if our population is growing faster than we're able to build housing to accommodate that population, then we're going to get price growth. And that makes sense. And I'm not arguing or suggesting that that thesis is incorrect. Of course, that is absolutely correct. And it's also correct that it seems like we aren't building enough houses, that there is a shortage of supply. And we only need to look to the rental vacancy rates as an indicator for that because, it shows that it's really tight. And if it remains that way, it will cause, or that one component will contribute towards property price growth. But I don't think it's as simplistic as that. And that's what I'm going to get into today. What I would like to do is share what I think is the key metric to determine what might happen to property prices. Anyway, so let's have a look at the data. And as always, talking about charts in a podcast format, in a verbal format, is pretty difficult or can be more challenging. So I would encourage people, if they've got the time, to go and have a look at the blog on the website because that's where you will see these charts that I'm going to talk about. Anyway, what I did is had a look at the different states over the last almost 25 years. 20-ish years, and I've tracked median house prices, population growth, and lending volumes. And I've done that since mid-2002. Interestingly, that's when I started ProSolution. Not for that reason, but the data set for the lending volume started in 2002. So that's as far as I could go back. But I think it's long enough to sort of start drawing a correlation. If you go back further than that, arguably the data might not be as relatable as it is today, given the lending environment's changed, the APRA's oversight of lending has changed, all those sorts of things. So what stands out in Sydney, so if we talk about Sydney, there is a very direct link between lending volumes and house prices, but the link with population growth seems a little weaker. So for example, when you look at the chart, population grew strongly between mid-06 and the end of 08, so that's sort of 2.5 years, but property prices barely moved over that period of time, even though housing supply, I looked at housing supply, it was relatively flat. But between 08 and mid-11, population growth slowed, but housing prices still rose over that time. Now, of course, these are relatively short periods of time, and there can be a bit of a lag effect, but it's interesting to note that it's not necessarily a great predictor, at least in the Sydney data, of housing prices. Now, I should say that a noticeable trend in these charts is the major disruption caused by COVID. So really from between 2020 and, maybe 23, 24, it's been kind of all over the place and it's kind of skewed usual patterns. So, interest rates obviously during COVID the cash rate was cut to almost zero. That drove a massive surge in borrowing. At the same time, we stopped overseas immigration. There was a lot of unusual interstate migration, and that's caused a lot of sort of disruption to all these numbers. So I guess we're really comparing the period of 02 through to 2020. That should be our main focus the last couple of years, it is a little all over the place, as I said. So in Sydney, the data shows that, yes, there's a strong correlation with lending volumes, but population growth, not so much. Now, when we look at the chart for Melbourne, it's actually pretty neat. We've got a very sort of tight trend in all three of these things: population growth, lending volumes, and property price growth. And perhaps that explains why Melbourne was, a really consistent performer probably up until the last decade. So you can see in the chart, in mid-2016, population growth started to decline. And there's a lot of stories around Melbourne, but of course, the last decade's sort of just grown at inflation, so no real growth. But the consistent growth in population has really benefited the previous period before COVID. Well, actually, really before 2016, when population started to decline. I guess the key question now is, I'm going to talk about in a tick. In fact, I'll talk about it now. Population has rebounded strongly. So more recently, population growth has averaged about 39,000 people per quarter over the past 2.5 years. And that's above the previous peak of around 35,000 per quarter back in 2015-16, before population growth started to decline. So it shows that Melbourne, except for the last 10 years, Melbourne has a history of generating strong population growth. The question is it returning to that? Well, the last 2.5 years would suggest yes, but time will tell, of course. It's worth noting that Victoria has the highest population growth in absolute terms. So that is in number of people moving, or number of people, the population increasing by number of people. And I think that's the most meaningful, right? Because we can look at like Perth, percentage-wise, its growth is slightly higher than Melbourne, but in absolute terms, because it's difficult in absolute terms to build absolute houses, of course. If one area needs to build 100,000 houses, another area needs to build 10,000. Well, 10,000 is easier than 100,000, of course. And it's interesting to note that lending volumes since mid-23 have increased significantly as well, primarily driven by owner-occupiers, not investors, which I'll get to in a second, but lower level of investors compared to history. So that's good signs as well. And while property prices have only grown modestly this year, it could suggest, well, these trends are certainly suggesting that there's more property price growth on the horizon. Interesting, if we move to Brisbane now, it tells a very kind of different story. For most of the review period, since 2002, Brisbane's population growth has been pretty steady. I mean, there was a little bit of an uptick recently. Again, that's the COVID impact. But otherwise, it's pretty much just a horizontal line, if you like. Now, as I said, COVID impact has been positive there. It's averaged over that period of time about 21,500 per quarter in terms of population increase. But since mid-22, so the middle of COVID, it's accelerated to about 30,000 a quarter. Now, it's come off a little bit. And the key question will be, what will the population growth be over the next 10 years? Will that kind of normalize? But lending volume has increased substantially. And so there's a very strong correlation with the Brisbane data between lending volume, but a much weaker relationship there with population growth. And if we move to Perth, the same sort of thing in that chart. We saw population growth fall sharply between 2012 and 2016, yet lending volumes rose and supported property prices. So we didn't see much change in property prices there. And prices only began to decline when lending volume declined at the end of 2015. So again, it suggests that money supply into a market is more important, or has a great direct impact with property prices than population growth might. And the same with Adelaide, to sort of round out the top 5 capital cities. Adelaide, between 2016 and 2020, population growth accelerated, but lending volumes came back, which means that property price growth was moderated. So if we look at the evidence then, the available evidence, it suggests that lending volumes are a much better indicator of what property prices might do than just population alone. Now, it's important to think about what the components of these borrowers are. So in terms of the proportion of investors versus owner-occupiers. But before I talk about that, I just wanted to address the fact that around about 26 to 28% of property buyers purchase without a mortgage. So looking at lending volumes alone doesn't represent the whole market. And I think it's important that we point that out, that we're just looking at people that are borrowing. That said, a proportion of all cash buyers tends to be relatively stable. So I think that means that the lending volumes that we're looking at are a pretty reliable indicator of the overall market. It just means that if we say that 40% of borrowers are investors and 60% are own occupiers, what we really need to understand is that's only the borrowing market, and the people that are buying without a mortgage, most likely, not always, but most likely they're going to be own occupiers, right? Because they're not using borrowings to buy an investment property. So the investment proportion is probably overstated. Put differently, if we assume, say, 27% of properties are purchased without a mortgage, and all of those are own occupiers. They won't be, but let's just assume all of those are own occupiers. And then of the properties that are purchased with a mortgage, let's say 60% of them are purchased by own occupiers. It really means that an overall perspective, both those that are purchasing with or without a mortgage, about 71% are own occupiers, which means then 29% are investors. So as long as those proportions don't change too much, I think looking at lending volumes make a lot of sense. So from here on in, I'm just going to talk about the lending volumes, not the overall market. So historically, it's been about a 35-65% split across the states. So that's maybe what we would consider normal. So 35% investors, 65% investors. Now remember, because it doesn't take into account the whole markets, but it's probably somewhere between, as a whole, 25 to 30% investors, which kind of makes sense, right? That number doesn't seem unrealistic. And I guess when we're in a market where there's more investors than own occupiers, maybe that raises some red flags, because what we don't want to do is go into an overheated market or a speculative market or anything like that. Having said that, when I look back at the numbers, typically during a growth cycle, there are more investors. And that makes a lot of sense, right? In a flat cycle, when sentiment isn't as positive, of course, it attracts fewer investors. So that, again, logically, that kind of makes sense. What I've done is I've had a look at the proportion of investors in each state from the lending data compared to the median amount of investors over the period of review. And it shows us that South Australia, New South Wales, and Western Australia has more investors in the market. Interestingly, the long-term median for Queensland is about 37%. It's about 38% currently. So Queensland's kind of almost bang on that average. And Victoria's the only one that stands out. It's got fewer investors. So 34% in Victoria is what the long-term mean has been, long-term median, I should say, and it's currently about 31%. And that hasn't changed very much. But, if you speak to buyers agents around Melbourne, they'll tell you that most of their inquiries and new clients are interstate investors. So I think those numbers will start to change. We'll start to see that. And again, that'll be another sign that we should expect some property price growth in Melbourne fairly soon. So then why does lending volume track a lot closer to property prices? Well, I think lending volume is a proxy for overall sentiment, or maybe putting it differently, it reflects all the factors that influence demand for property, including population growth. And so I think it's a good proxy. The reality is that there's lots of different things. Some are going to be local or geographical matters, and some are going to be federal matters, but there's lots of things that can influence demand for property. And that's essentially what we're trying to understand. We kind of know what supply is relatively fixed. I mean, we can change sort of housing approvals and that sort of stuff, but as we can see, no matter what the focus is, it doesn't really change that much. So we know what supply is. The big variable is demand. And that's what we're trying to measure. When demand is really high in a particular state, we're going to get price growth. And I think lending volumes are a great proxy for overall demand. And again, I know it only reflects those that are borrowing to buy, but again, as long as the proportion of cash-only buyers doesn't really change, then I think it's a good way to test a market, particularly if we're comparing apples with apples. So we're only comparing everyone that borrowed today versus everyone that borrowed back in 2002. So we're comparing the same data set. So let's have a think about then, there's several factors that will influence demand for borrowings. And that's why I think it's then inherently a good proxy for overall sentiment. And there's going to be things that are going to be sort of national, and then there's going to be things that are specific to the location. So that is, of course, interest rate settings are the same across Australia, but we've got different markets behaving differently. Of course, Melbourne versus Perth is a great example of that. Okay, so let's talk about the things that can impact a particular state or geographical location. And so I think the biggest one in the shorter term is sentiment, just general consumer sentiment, and then sentiment around property. And it probably has the biggest impact. And we can see that in lots of different ways. So I know when there's, things like wars or Trump's behavior or these sorts of things, when there's a lot of uncertainty as a result of those sorts of things, podcast listens reduce, level of inquiry in our business can come off a little bit, but when things are a little bit more stable, those things kind of return to normal. It's really interesting, and it's just, I guess, natural human behavior. When there's a lot of uncertainty, we tend not to want to make decisions. But the same thing can be associated with a particular state as well. And again, Melbourne or Victoria is a great example. There's been a lot of negative sentiment towards Victoria, its taxation regime, especially as it relates to property and its general overall debt. Now, sentiment doesn't have to actually align with fundamentals or facts, because if we look at the facts, yes, there's been a lot of additional property taxes, but when we look at the overall tax raise, it's not that far off what Queensland and New South Wales are taxing their state in terms of, and the change over the last 10 years, as Campbell shared in a recent podcast, it's not that far off. So, and when you look at population growth, highest in absolute terms. So there are some actual fundamentals, but I'm not going to argue against the fact that we should have a negative sentiment towards the current government. Of course, that makes sense. But sentiment will drive markets, all markets, in fact, in the shorter term. The next thing that's going to dictate lending volumes is economic health. And the key thing, it's just an overall strong economy will obviously mean people are comfortable to make borrowing decisions. But the key thing here is unemployment rate. And when the unemployment rate is relatively low, it means people have job security and they feel comfortable borrowing. But if the unemployment rate is to increase and there's a lot of people losing their jobs, redundancies, all these sorts of things, typically you will see, or you should expect, lending volumes to reduce, and that's going to have a negative impact on property prices. So at the moment, the seasonally adjusted unemployment rate is 4.2%. That's almost bang on a balanced labour market, almost close to what they call NARU, which is the non-accelerated inflation rate of unemployment, which means the level of unemployment that means that it doesn't put pressure on wages, essentially. And so that's a balanced market. So that looks really healthy. Next element is obviously population growth. As I've spoken about before, we typically can't build houses as fast as we can increase our population. And I know there's been a lot of talk and rhetoric about that. I should say, just by the way, the criticisms with immigration, the government, I don't want to participate in that political discussion. But when you look at the average immigration, I looked at it a while ago, over the last 5 years, it hasn't really changed that much. The difference is that obviously we've had a lot of immigration the last couple of years to make up for COVID period. So I just thought I'd point that out just as a sort of fact-based assessment. I don't want to participate in the debate around what the right immigration levels, not at least in this podcast. And lastly, and we should not ignore this, and we need to always keep it, I was going to say the back of our mind, but probably the front of our mind when looking at property data. The other thing it's going to be influenced is capital improvements. So don't forget, property prices are a combination of both the underlying land value and also, which depends on supply and demand, and also then the capital improvements that sit on that land. So it's entirely possible that we can see population steady or population growth steady, lending volumes increase, and therefore property prices increase. And so the key thing to ask there would be, what's driving that? Well, either there's been a contraction in supply, that there's been fewer houses built, probably unlikely if it's really stable, or what's happening is people are borrowing money to make improvements. And then when they go and sell that property, the improvements are obviously reflected in its improved value. And so we can never ignore the fact that when we see property price percentage increases, so when they advertise, these properties increase 10%, we need to always reserve and understand that only part of that is going to be driven by the change in underlying land value. And that's really present in new build areas, for instance. So, where we might see the sale of land initially, and then people are going to build on that land and they sell dwellings. And then as that area gets more investment and there's more dwellings and more investment, you typically see that uplift. But those uplift factors, or the things that's driving that uplift, will be the capital that's been invested in that location and a little bit of probably underlying land value improvement, but mostly the capital. And different markets will go through sort of different phases. So it's possible, this might not happen at a total state level, but it's possible that, a lot of capital improvement or gentrification occurs in a particular location, and then that can artificially drive property prices higher. When I say artificially, I mean it's not really the underlying land value, but it's because people have spent more money on the actual improvements in that location. Okay, so they're the things that can drive demand for lending that can be different in different states. Of course, there's going to be different things. There's going to be factors that are also national as well. The first one is credit standards and lending appetite. So firstly, credit standards, any changes in borrowing rules and so forth do impact demand for borrowing, just because there's an underlying level of demand for borrowing. And then only obviously the people that can qualify for that borrowing can actually do so. And so if we tighten credit standards, of course, that's going to have a negative impact on lending volumes, and then also a negative impact on, therefore, property prices. And probably the biggest change over the last few years, which I've mentioned heaps of times, is the lending buffer. So at the moment, the lending buffer is 3%, which means that if you go and apply for a loan, you will be tested to ensure you can afford the repayments at 8.5%, 9%, for instance, just 3% above whatever the interest rate you're going to end up paying. Whereas if we go back to December 14 and before that time, the loan buffer used to be 2% with a 7% floor. So that's a percent lower. So instead of testing you at 8.5%, 9%, it would be 7.5% to 8%, which I think seems more reasonable, right? Because home loan interest rates haven't been above 8% for a very, very long period of time. And just because of household indebtedness and overall government indebtedness, I don't think they probably at least will in the foreseeable future. And then also banks can change their lending appetite. So, a particular bank might be uncomfortable with their investment loan book growth and therefore, change some of their policies to sort of curtail that, or vice versa. They might be growing less than system and they'll be keener to pick up some market share and loosen credit policies. So lending appetite can change from lender to lender also. And lastly, interest rates. Of course, interest rates have a really big impact on the demand for borrowing because that's really the price of money. And we know when the price of goods falls, of course, demand increases and vice versa. And so when we saw that more recently, when interest rate went through a hiking cycle, we saw lending volumes come off. And again, obviously, as we've had a few easings over the last period of time, we've started to see an increase in lending volume again. So as you can see, there's heaps of factors that go into dictating or influencing lending volumes. And that's why I think they're a really great proxy, and history tells us they're a really good proxy for what property prices might do in the shorter term. Now, why is that important? Well, it's important because I've previously spoken about and shared charts around property price growth cycles. So that is that most property markets, or all property markets really, since the time I've been studying back in the beginning, the data begins in 1980, go through two cycles, a growth cycle and a flat cycle. And this thesis also benefits from the idea of mean reversion, which means that returns eventually revert to their long-term mean. And that obviously means that if you've had a period of above average growth is typically followed by a period of below average growth. Makes a lot of sense, right? So if you look at a blog I did recently or published recently, episode 370, I looked at the growth over, the price growth over 1, 3, 5, 10, 20, 30 and 40 years. And the thesis behind that episode was really about we should be guided mostly by long-term trends. And when you look at that, it shows that Adelaide, for instance, has produced a return, a growth rate, capital growth rate, over the last 10 years above its long-term average. And so that would suggest to us that with mean reversion, that we should expect the next 10 years to be below average. And so I think we can use lending volumes to give us an indication of what price growth or property price growth might look like in the future. Now, we can't just use it in isolation. We've got to marry those two things up together, I think. We've got to look at what have markets done? Where do we think they are in the cycle? Because previously in that, I looked at, the average growth cycle lasts 10 years, the average flat cycle lasts 7 years. Now, again, there's no perfect science to this, but we then generally can then form a view as to where are markets in their cycle? And therefore, if we're going to make a new property investment, what market do we want to enter in? What market gives us the best opportunities for better or above average growth over the next 10 years? So looking at that data and marrying that all together, it seems to me that Adelaide looks a bit of a risky market, which is not to say if you've got a property in Adelaide, you should go and sell necessarily, but it's possible, or I think it's quite likely, if you look at all the parameters, it's quite likely that the next 10 years won't be as good as the last 10 years. I don't think I'm really sticking my neck out by saying that. Having said that, lending volumes are still increasing in Adelaide. So we're probably going to see some more price growth this year. And we're seeing that, although it's moderating a little bit, but at some point it's important to sort of watch what's happening with that lending data, because that'll give us an indication of when that market might turn. Perth and Melbourne still stand out to me as the best markets or the markets that probably exhibit the most opportunities, I guess, over the next 10 years. And of course, the premise here is, we're buying investment grade property. So something, not just any property, but a really good quality property, as I've spoken about. And perhaps Melbourne edges itself in front of Perth. Well, not perhaps, I think it does. Not only because it's just such a much larger capital city that's growing, in absolute terms at a much faster rate than Perth and has more diverse employment opportunities, but its investor percentage is lower. So I think that's going to change over the next couple of years, which will fuel the fire a little bit. And we're starting to see that already. So what happened in Perth back in 22-23 is that we saw interstate investors drive that market initially. And that's normal, right? Because you've got probably a less emotional viewpoint on that market, because if I'm not living in Melbourne, I can just look at the data and think, yeah, it looks good. Relative value looks really good. Whereas if I'm in Melbourne in the thick of it, maybe I, can't necessarily take as pragmatic view as that. And similar to Perth, when we looked at Perth, relative value looks good, and investors started to get into that market. So they're typically the cohort that drives the initial change. And as I said, if you talk to any buyer's agents, they'll tell you 70 or 80% of their new clients over this calendar year, have been interstate investors, or at least are investors, which is distinctly different to the previous years where most of the activity was being driven by owner-occupiers. And so for that reason, I think Melbourne's set to enjoy some nice growth. I've spoken about that a few times in this podcast before, but it's really pleasing to see certainly an uptick in lending volumes over the last few years, and that's a really positive outcome. So next time you hear people talking about population growth, it's all very good, it's important, but it's really important to recognize that there could be like 10 factors that influence prices over the next period of time, and population growth is only one of them. And you might have population growth being positive, but if you've got 4 or 5 other factors that are negative, it's going to offset that. And I think the data shows that today. So lending volumes, I think, are the key metric here. Okay, I'm going to try and answer one question before I leave you today. So the listener wants to remain anonymous. Firstly, thank you for the podcast. It's put me on a sharper path, and I'm working my way through the books, and they're throwing up more questions than answers. Sorry for that. But as your book says, a great question is better than a great answer. Yeah, that's true. Happy to remain anonymous for this podcast. My question has a few factors here. Here's the necessary context. My wife and I own a home in far north Queensland worth $900,000 and have no plans to move. We're very happy here. We own our cars and have no other debt, no credit cards. I think no home loan debt as well. Combined super is about $475,000, both in early 40s. Annual income of $220 with 15% super. Obviously must work for the government. We plan to make contributions once we iron out a property strategy. Using an early inheritance, I established a discretionary trust, and we've purchased 2 units in a popular, well-established complexes. The purpose was for our daughters to have a foot in the property market. The way things are going, we don't believe it'll get any easier, and we would like to access them about 20 years' time. So unit 1 is worth $365 with $205,000 of debt. Unit 2 has $390 with $260 of debt. We plan to make $1,000 contribution per fortnight into the trust to pay down unit 1 aggressively and service the P&I loan on Unit 2. The broker estimates we have about $700,000 of borrowing capacity. I'm sitting on $170,000, I guess, of cash of the early inheritance and trying to determine my best option. And then the listed 5 different options, including, buying a third property, paying down debt, doing those sorts of things. And lastly, the listener writes, I am risk adverse, leaning towards option 2, 1 or 3, which is pay down debt, as it reduces debt and spreads the risk across stock and property markets. Is there any other options I should consider? Well, there's a couple of learning things here, I think, for most listeners to really think about. And it's a common situation where, clients approach us, or we meet the clients after they've made the decision, as is the case of this listener, where they've purchased property with the intent of helping children in the future, but that future is long-term future. So this listener wrote sort of 20 years time. And I would counsel people from not doing that. So lots of things can change over the next 20 years. How do you know that these properties are still going to be appropriate, particularly if they're in a complex? The complex might be well maintained over that time and only improve, or it could not be in disrepair. Kids might not actually live in that location anymore, though you can argue it can be a pure investment property. Instead, I think a much, much better approach for parents is to look after themselves first. What I would have invited this listener to think about is make the best investment decision for yourself, knowing that you do want to help kids down the future. It's early inheritance, and the plan is in 20 years' time, you want to help your kids get into the property market, 100%. But make sure, so then the question then is, how do I take this early inheritance and grow it as much as possible over the next 20 years? And the answer is make the best investment decision, irrespective, not without regard, without considering what might be appropriate for your 2 daughters. So in this situation, we've bought 2 properties thinking 1 each, but it's never going to work like that because kids are going to want the money at different times. The properties are going to grow at different rates, all these sorts of things. And so what I would have done in this situation is I would have probably put the budget together, bought one better quality property, even if it wasn't in the location where I'm living, knowing that I can hold it for 20 years and then potentially sell it down the track. And then I can help and use that capital to help out kids. So that's the first thing, is be really careful about saying, I'm going to buy this property because I think my kid's going to go to university in the future, and it would be great they can occupy that property when they go to university because it's close, it's just down the road. Something along those lines. We tell ourselves a story sometimes about money, and it doesn't always help. So just caution in regards to that. And the reason for that is quite often we make a compromise in asset quality to try and tick also the lifestyle box, and that's the issue here. Secondly, buying property in a trust, be careful about that as well. Often in most states, you pay higher levels of land tax, and negative gearing is trapped inside the trust. So you don't get the benefit of negative gearing and you pay more land tax. And even in the states where you don't pay more land tax, all the other states levy higher land tax, so it's probably only just around the corner. And if you're going to live in that structure, live with that ownership structure for the next 20 years, you've got to really think about what the risks are. So typically I don't like buying property in a trust. So in this situation for this listener, what I would do with the $170,000 is I would put it in the offset account. I would never ever pay off a mortgage, always offset a mortgage, because that way you can always access the cash later on. Whereas if you pay off a mortgage, it's gone forever. You can never re-gear that property unless you change its ownership, but you're not going to change its ownership because of stamp duty and capital gains tax. So put the money in the offset account, get it to neutral. You want to make sure that your family trust has a taxable income before you start investing in shares. Because if you invest in shares in the family trust and it doesn't have a taxable income, you will lose any franking credits, any imputation credits in that particular year. So put the money in the offset, make certain it's going to record a positive cash flow, the properties that is. It doesn't have to be massive, can be a few $100s, whatever it is. And it's going to depend on the interest rate in the particular year, of course. And any surplus monies, I put in a diversified ETF just to balance up liquidity and diversification and those sorts of things. So that's what I do in that situation, but thank you very much for the question. And thank you to everyone for listening and sharing the podcast, of course. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.